TheoTrade. This is Don Kaufman. It's January 24th, 2019, and you are watching the TheoTrade evening video. We are just moments after the cash close of the marketplace, and we are seeing earnings come out for none other than Intel. Right now, the market taking it considerably lower at this point in time. For those of you that have an interest in this, Intel was poised to move right around $2.40. You can see I've got a number of positions on this front. So again, Intel was poised to move about $2.40. It closed the day in and around the neighborhood of $49.76. Where is it right now? It is outside, again, outside the expected move, but not substantially so. So right now we've got what? About a $2.76 move, okay, on an expected $2.40 move, and it's still early in the process. There's still an earnings conference call to come out. We believe very heavily around efficiency in many of these earnings announcements. But the reason I'm bringing up Intel right now isn't so much about Intel. It's about the impact that Intel is having, okay, on the broader marketplace, specifically on the Nasdaq. You know, Intel happens to be a real key player in terms of market capitalization, not only in the Nasdaq, but in the S&P at a market cap, of over $220 billion. Intel has tendency to fall by the wayside because it's not per se one of the monsters of tech. It's not an Apple. It's not as exciting, if you will, as maybe a Netflix on a day-to-day basis. But you know what? It carries weight, and that is market weight because it's market capitalization. Look what it did to the Nasdaq here. It took hours for the Nasdaq to climb today, all to be given back in literally moments. Just to show you the impact exclusively here of Intel, the Nasdaq traded 67.10 down to effectively 66.80. It's good for a 30 handle move inside of the Nasdaq in the after hours. Okay, again, how far does that kind of market capitalization go? A long way, because it moved the S&P 500 8 handles to the downside. Now, other earnings that are out in the after hours, nothing as huge, of course, as Intel, but always interesting is none other than Starbucks. Get your fill right here of some liquid crack. The stock is largely indecisive and unchanged right now in the aftermarkets. It is slightly bid up, but in what's I would consider broken and scattered trade. Again, we're only seconds after the earnings announcements has been released, specifically in both Intel and Starbucks. With that, let's get to the broader markets. So the S&Ps today had a very much an inside trading session, scattered kind of broken trade. How did volume look, okay, on the entire day? Well, it was light. We did about 1.2 million contracts in the S&P futures in what amounted to, again, some brokered and scattered trade. The 2626 was tagged. The irony of that, again, we've been talking extensively about our gravity points, okay? Is that clean enough for you? The gravity point of 2626 is hit to a T. Not even a rounding error to deal with on that particular front. We bounced off of it. Okay, again, some sell-side activity almost exclusively because of Intel here in the after hours. That may not bode well for some of the other tech stocks that are going to be released, of course, next week. That's why we're kind of keying into Intel. But rather than try to read into today is what I would term a veritable slop fest of trade today, I want to look at markets for just a moment on a bit of a broader sense. For this, we're going to cruise over to the spiders, okay? The spiders. And I want to take you back to ultimately the time right now of late September coming into October. So in October, we formed, okay, the volatility box, which, again, we've kind of dubbed this the hurt locker. This was the beginning of volatility really starting to pick up in the broader S&P 500, followed by, of course, that wicked move in December, followed by what has become a wild rally back to the upside. So this is, again, nothing that you haven't seen yet. And I was comparing for quite some time what was going on in the S&P 500 to, for example, the VIX. And the one thing that I've really picked up on when I start looking at how volatile things really got back in October, November, and December, and then I looked at the VIX, okay, the VIX did an absolutely horrific job of, first of all, there's no predictability whatsoever using the VIX to kind of guide us. What effectively I'm saying is the VIX hasn't told us squat that we didn't already know. Okay, if the S&P sold off, it was like the VIX was literally the last person to be told. The S&P sold off and started selling off hard. I mean, come on. You got to look at this and recognize here we are. This is early December time frame right in here. That's early December time frame. Do you have any idea what the S&Ps were doing? Okay, right again in this time frame. All right, I'll kind of box that out. The S&Ps are absolutely tanking. What did the VIX do? It waited. It waited until it looked so serious, okay, that we were all on fire before actually taking off to the upside. So I counter, okay, with the idea that the VIX isn't worth very much to us other than to confirm a move that we're effectively already seeing. In fact, at this point in time, I find the VIX rather useless. It's kind of like my predecessor's indicator. And I start using things like the VVIX. And the VVIX, however, the VVIX, okay, spikes and only, again, confirms when we're pretty much, tanking on fire. When that VVIX, though, gets above like 110, that's duck and cover, get under your desk and start rocking back and forth. Nevertheless, I started looking, again, at a number of indications of broader risk in the marketplace to say, hey, okay, when the S&Ps were about to stage a very, very substantial sell-off. And again, I'm bringing up the spiders here because I think it's the cleanest view. And as I was kind of delineating a moment ago inside of the VIX, I said, well, what was going on in early December in the VIX? And nothing was going on in the VIX. Look at the S&Ps at the exact same time. And this is early December, with the S&Ps taking off to the downside. The VIX was doing absolutely nothing. So what may have told us more effectively that risk was forthcoming? And that's when I started to look at the bonds in a little bit more detail. Okay, the bonds, again, they saw something at this point in time. Now, you have to remember, as the bonds go higher, okay, as the bond itself goes higher, where does the interest rate, okay, or the rate associated with this bond or note go? Okay, and that is its percentage yield, or the rate, the percent goes effectively down. So if over here, for example, we were sitting at like a 3%, okay, as we actually rally up, the percentage is going to drop, for example, down to like 2.7%. Now, why am I showing you this? Because the bonds were doing a number of things counterintuitively at this point in time. One of the counterintuitive things is, first of all, okay, as the bonds are rallying at this point in time, the Fed was clearly getting ready to do what? Well, they're getting ready to raise rates, and they did raise rates right in this neighborhood here. Okay, so the Fed turns around and raises rates. Bonds, they didn't care. They just kept right on laughing, buying them up. So they're buying bonds. So why are they effectively buying bonds? Why is the marketplace buying bonds? You have to ask yourself that question. Okay, most likely to mitigate risk. That the rotation of capital into the bond markets really started well before we saw the hideous sell side activity that started to not only persist but really came into full steam ahead in the December timeframe. Most of that, again, it appears to have been seen already by the bond markets. And again, all I'm doing right now is just taking you into the past, kind of warming you up for, well, what's going on right now in the bonds. All right. The bonds early this year, they came back down. Did they come back down considerably? Not at all. The bonds, okay, when they rallied up, and again, this is the exact point that I want to make, and I'm going to try to do the best I can at kind of scripting most of this move. The bonds from some of the more recent lows, okay, and that's right down in this neighborhood here, we're trading effectively 137. They take off to the upside. They hit clear into, I mean, we'll just round it. Okay, that's 149. By the way, bonds trade in ticks. One tick, right? One tick. What's a tick? Well, there's 32 ticks to a 1-point move. So again, when you see 27 ticks, that's effectively rounded up to 32 ticks. It's a 1-point move in the bonds. So yeah, we moved clear from 137 up to 149 in the midst of some sell-side activity. Now, a massive rally has ensued inside of the S&P 500. And you saw the S&P 500, which I'll actually show you again in just a moment. The S&P 500 tanked in December, took back off, and we're this far back. What did the bonds do? Not much. And this is actually a very large cautionary tale because the bonds have only moved from 149, okay, and retrenched back to what? Let's get crazy. They've gone back to what? 144. So for the most part, they make this, again, fairly stellar move to the upside to only give back a few points. At this point in time, I think we need to look at this, okay, vastly different than most may have, or maybe you don't even necessarily look at the bonds. I think you have to look at this and say, what do the bonds know right now that we don't? And again, the point to be made, yeah, the bonds sold off a little bit. But did the bonds sell off as much as the spiders rallied? Not even close. On a percentage basis. Again, spend some time. You can compare, contrast. You wouldn't expect the bonds necessarily on a percentage basis to move as much as the spiders. Okay, but the spiders have actually, and the S&Ps have retrenched all the way back. Okay, all the way back. And it's like, again, most of December never even happened out there. And yet the bonds, okay, the bonds tell a very different story. The bonds, if you look at the bonds, they backed off, but minimally so. In fact, when you really start to zoom into the bonds, okay, and for what it's worth, again, the bonds gave back a couple of points, but they only really gave back what was what they gained in some of the most serious moves that we saw, okay, in the midst of some of that sell-side activity. If you take a look specifically at the notes, the exact same story. You can even take a look if you want at the ZT, which is the 2-year. It's the exact same story. All, okay, of your major debt markets appear to still be pricing in this really, really high degree of risk. Or you could take this completely differently. You can take it as, hey, the debt markets, they're keeping interest rates low, and they're going to keep interest rates low for a very substantial amount of time. Maybe that could be construed as a positive, but at this point in time, I look at this, okay, as the marketplace is still pricing. The bond marketplace is still pricing a considerable amount of risk into the S&P 500 because clearly the VIX ain't doing a very good job of it. With that, I want to thank everybody for joining us tonight here at TheoTrade. Have a wonderful evening.